So we spent a lot of time talking about the government guaranteed yields because it's on everyone's mind with the recent move. But let's just talk about some things going on in the credit markets. They don't look that bad. The risk doesn't look that bad because a lot of companies have shored up their balance sheets. The consumer, arguably their balance sheet was good going into COVID.
That's
it's
right.
getting better with economy opening back up and $1,400 checks in the mail. And so
And don't forget that $1,400 check, in most instances, is way more than $1,400. It's $1,400 per person and some dependents with tax
That's
credits,
right?
So on an average family of four that's making medium type of income, you're talking about something that's around $4,000. That's a lot,
Yeah.
right? That's an annualized rate of almost $50,000 a year, right? That's a huge increase. But as you mentioned, the balance sheets are good. Look, corporate America's smart. They financed, they took advantage of the environment. They're ready for the cycle. They're sitting on cash in the balance sheets, and you're seeing it as you see from your chart. You're starting to see this improvement in the upgrades as well. So some of the fallen angels from last year, those are the names that go from the investment grade world down to below investment grade. They're on upgrade watch right now, and there's a lot of speculation that most of them are going to come back. So it's a blip. This is what happens during a recession. You get spikes in the downgrades and the defaults. And when you think about it, the default was really centered in a couple of areas, right? The defaults last year were primarily in the energy complex, right, which has been a problem, and retail, which had been a problem, right? So if you start to really think about it, it was, COVID was the Great Accelerator. That's the phrase I think people have glommed onto, and I like it because it just accelerated a lot of the trends underway. So this is what happens in a recession. You're supposed to clean it up. It's supposed to improve. And at least for the near term, let's say the next kind of 2 years, credit looks attractive. The problem with credit, though, is that some of it has duration, like the investment grade market. It's priced pretty dang well today. So you've got to be very careful. And you've seen that, too, as of late. The weakness has been in like the double B part of the curve, right? The part of corporate bonds, which is considered junk or below investment grade, but it's the highest quality junk, as we like to call it. But that stuff's been weak because it had rallied so much. So at the end of the day, we always say there's no bad bonds, it's bad prices, right? So it matters what you're paying for it. But this is accretive to credit. This is why we have a balance. This is why we have a tilt to credit across our strategies right now, because we just think that it's accretive right now.
This is another view, kind of same concept. Defaults seeming to have peaked and probably coming down.
Yeah, and I said it's pretty concentrated in a couple of industries, right, in sectors of the market. So this wasn't just some rampant default experience that you just bled everywhere in the economy. Now, you could argue that small businesses and stuff took a disproportionate hit, and something we focused on in many webcasts and the like. But yeah, I mean, to me, this looks like this has peaked out. You look at the forward-looking prospects, you look at earnings. Yields are lower, coupons are lower, so the refinance ability, the debt service is better. There's a reason to be somewhat bullish on credit. You just have to pick your spots. Yeah,
and you can't really blame these investment grade corporate bond issuers. I mean, if you can borrow out 10, 15 years instead of 5 years, you're going to do it.
That's right.
Just like when you take out your mortgage, if they'll give you that 30 year, hey, why not 40 years?
Why not? Why not? And so you might as well do it. And the good news about corporate America is they're bullet structures. You don't have to amortize. You don't have to pay them down, right?
Moving on to the consumer, I use these charts a lot when we talk about structured products because a lot of structured products is backed by consumer mortgages, credit cards, auto loans, student loans. And in April last year, I wrote a couple white papers about housing, and my big thing was that the consumer was not in that bad of a spot going into this. And you can see that if you look at income. In fact, weirdly, we love this. We love this chart.
I called it the chart of the year last year.
Incomes go up. We're in a recession. Incomes are supposed to go down, but because of aggressive fiscal policy and the transfer payments, incomes actually went up. They dropped because those transfer payments went away, and then we got them back again.
Right. And so this doesn't even include the latest round, right? So that's the January number where they got the emergency in there, what you see in that blue line. You don't even have actually the latest data in here too, because again, it hasn't been reported yet. But we know stimmies, as we're calling it around here, right? Stimmies are going out. People are getting their checks, and so these numbers are going to continue to go up. You're probably going to see a blip down in February, like you did the last time, and then you're going to see it go right back up, and you're going to set a new all-time nominal high here.
And as a function of that, not all of it is being spent. Some of it's going into GameStop and Bitcoin and stocks.
And I would argue this time that maybe it doesn't go as much into that. It's going to go into that trip, right? You've seen this with like TSA throughput. We set new records this
Well,
weekend.
it's Bitcoin is down. It's down a lot from its highs. It's down about $10,000 from its highs. It was.
Yeah, but it may be up 10,000 while we're talking.
It could
right,
be.
too.
It could be.
Yeah,
But
yeah.
yeah, I mean, you're starting to see kind of less interest in the Robinhood app. I saw it fell off the Apple iStore 100 top 100.
Yeah.
So it feels like people want I'm done day trading. I'm gonna go out with my friends again.
Yeah, no, I mean, look, and you're seeing this in activity, and that's why I was mentioning the throughput at TSA. I mean, we have 1.5 million travelers. The peak was around like the Thanksgiving and Christmas season last year. It was like barely over 1 million. So you're seeing that activity. You're seeing it, reading news about like Hawaii and these destination places really picking up, and they need it, of course. These tourist spots, but you're seeing this, especially the sunshine areas and spring break right now. So I would think that some of the savings is going to get spent. The other thing about savings is it's a plug number. We know income, we know consumption, so savings is the catch-all too. So it may be a little distorted, but what I just find amazing here is like the savings rate, how much it went up during this. And that's what happens when the government mails you money, right?
Yeah, that's right.
Yeah.
All right.
And the other thing that's kind of perverse is that we have a 0 interest rate on savings accounts. So government sends you money. It's not like you're going to make money leave it in the bank, right? So either you got to do something with it or spend it.
Well, it's actually a problem for the banks. The banks are so flush with cash, and the C&I loan production was down because they get bearish and they don't want to lend money.
Right.
And so they have to go buy stuff, and that's one of the bull case, not necessarily bull cases, but one of the reasons we're not so negative on agency mortgages with some of the the capital rules rolling over.
Yep.
They've got to buy something, and they're going to buy agency mortgages.
And agencies have better treatment than treasuries, which is weird, but welcome to the government. But also on top of that, you've seen this idea that potentially they're going to charge rates to consumers, like JP Morgan and the likes have said that because they have so much cash, they don't know what to do with it, and then the capital charges hit them. So I do think that there's some kind of nuance there too, and you see this with the Treasury General Account being drawn down right now. But it's being drawn down to mail out the stimmies, right? So if everybody turned around and saved it, it would actually cause a problem. It would actually cause some short-term negative rates. It would put pressure on money market funds as well. So that's why I don't like money market funds really in general. I mean, if you're going to buy the front of the curve, why not go get some yield, right?
Yeah.
And so playing around with a couple of basis points and it can turn negative on you, and I can lose money there, doesn't make a lot of sense. So for that cash-sensitive investor, I say put it to work. You don't have to go take a lot of risks, but go out the risk spectrum a little bit. Go to like a low volatility, low duration type of strategy.
Well, Ray Dalio says you should borrow as much as you can and go buy stuff, right?
Yeah, well.
As a function of all the stimulus, as a function of the savings, again, one of the things that we've seen that's odd is that usually delinquencies rise during recessionary periods, and in fact, they've dropped. They've recently ticked up a little bit, but they're still actually below where they were pre-COVID.
It's just surreal, right? I remember a year ago us, doing our virtual meetings and just being panicked. The weekend calls we were doing, trying to figure out what's going on in the mortgage real estate market, the commercial real estate market, and just the how mired we were in all of this. And then you had an administration that told people, don't make your mortgage payment. Here's a moratoria or various moratoria on rent programs and the likes. And here we have delinquencies just, at pre-crisis levels, right?
Yeah, I actually tell investors it's a dangerous thing to look at this data and extrapolate it, because you have very low quality borrowers that are making payments because of all the stimulus that they're getting. And one of the issues you have with looking at the past using a logistical regression is this is going to make the credit look too good. Just like if you regress the data from the housing market, it made housing credit look really bad, so you wouldn't want to go buy. So enjoy this now in the performance of your credit, but don't necessarily use this to extrapolate all your decisions in the future.
Yeah, and be careful with your logistical regressions.
Yeah, that's right. All right, so let's move on to something that's way more exciting than bonds, stonks.
Yeah, stonks, yeah.
And the big theme out there is the great rotation. I mean, it's the enamor of equities by the average person out there. It's pretty wild. I mean,
it feels like the late 90s, and I'm not trying to say there's a crash, right? It's that where it's the buzz. Everybody's talking about it. All my friends and neighbors and everybody all want to ask me about it, right? And it's like, it's just one of those kind of, you have this peak madness going on. Now, doesn't mean that things have to collapse from here, but there definitely is a resurgence of this. And I'll be curious to see, as we talk about the vacations and like in the service spending, do you actually see money go back in this? We've seen a lot of the call volume come down in some of these retail stocks. but there's new ones all the time. So, but it's definitely, there was this idea, but I think as people go out more, they're like, who cares? I lost some money on that trade. Why am I going to do that again? HODL, paper hands, diamond hands, all that great stuff that's come out. I have paper hands. When I make a lot of money on a gain, I sell some, right?
Yeah.
I'm not a diamond hand kind of guy. But then again, I didn't grow up around diamonds. I grew up more around paper.
Okay, so last year, of course, big winners in tech and things like Amazon, which I think sits in consumer services, in discretionary, yeah. Energy being the big loser, real estate not doing well, of course, and financials. And then you flip forward to this year, and it's the laggards that are all playing the catch up, and they're the big winners. Yeah,
and you look at this. I mean, look at the left-hand side: energy, financials. Financials make sense because the curve. I mean, remember also when people talk about the Fed. Remember, the Fed wants the banking system to work, right? So the Fed's kind of incentivized also to have a steeper yield curve because it's good for the banking business model too. And you're seeing some of that rebound there. The consumer services is just kind of this it's kind of the value trade as well. You see value there. Industrials, that's kind of a hybrid. It tends to be a little more growthy oriented. And then the other ones are kind of bond proxies, the real estate and the like. So it's pretty interesting to see that momentum has kind of fallen apart. But what's really weird is how we define these things, right? When you talk about factors and stuff, because actually value is becoming momentum.
Yeah.
So it's kind of weird. People think momentum, growth go together, but the value, because it's working and the tech stocks are going down or have come off their highs, let's say, what you see is now momentum is actually value too. So it is kind of interesting. I think you'll start to see that shift into value. So I wonder if momentum gets whipsawed.
Yeah, I mean, I've seen people talk about the CTAs may move into, and all like the tech-related trading stuff's going to move into
value, right? Yeah, that's a big. And I had a podcast this week with someone, and he was saying that there's roughly $4 trillion that'll likely move in that rotation on there too, over the course of a couple of years. But it is interesting to see. But when you talk about the great rotation, it's not from like bonds to stocks; it's like within stocks too. But this is what creates a new bull market. If you get new leadership, you get things going back. And remember, value needs higher yields. It does well, it does better in an inflationary type of environment because that's not real growth, where growth is at a scarcity. So as I look at it, I mean, it does make sense on what's going on. It's been a big move over the last 5 months.
Yeah, absolutely. And here's one that really shows the liking higher yields is, of course, financials. This is the 10-year Treasury yield in red, and then you've got the S&P, the banks, the U.S. banks over the S&P on a relative basis. So there's relative outperformance of financials, almost right in line with rates going higher. I know you hate these overlay charts, but
that one's hard to argue with, right? That one's got a pretty good fit there. But as I like to say with all these charts, it's directionality. It's not, they don't have to be precise, and you can't criticize it for that, but the directionality is dang good there. Yeah.
Yep. Here's S&P. We're going to look at a bunch of kind of relative charts just to show the relative outperformance or underperformance. Growth versus value, of course, a huge outperformance, and now giving that back.
Yeah, and I mean, this is just the rotation where a year ago, we were never going to get out of this. We're mired in this. There's never going to be growth again. We're never going to go out of our houses. It's that uber pessimism that drove the valuation on growth. And I remember listening to a webcast from a strategist I respect, and he was saying, if you're buying the FANGs and the tech stocks, this was like in September, at these multiples, you must be extremely bearish on the entire world. Because the only way these multiples make sense is that we're never going to grow again, or at least for the next 10 years. And so that's contrary to what a lot of investors would really think about. It's like, no, it's been performing well. It's going to continue to perform well. But we know that, at the end of it, no stock has ever grown to dominate the world. Yeah. Right? And you can think that Facebook's going to do it, Tesla, whatever. History has been a guide. There's been no stock that dominated the world, or we'd all work for it. Right?
Like RoboCop.
I don't want to live in the RoboCop world either. But anyway, as you think about that, what that is, there's just natural rotation that goes on over time because valuation matters. Short-term valuations irrespective of the day-to-day fluctuations, but when you look over the longer term, and this is why we've been bullish on value. If you go out there and look at this too, our equity PMs that run our active value strategy, and again, they have a skin in the game, they run value over time. They're extremely bullish right now. They put together a great paper for our people watching. Go to the DoubleLine website and grab that paper. Yep. It's long-lived value. It's it's a great piece because it doesn't take one metric. It takes almost every single valuation metric you can look at, and it shows how distorted it's been and how it's such an extreme reading, especially relative to the growth. And so this is set up for a long-term bullish area. And we like value. Even our systematic strategy has been tilting towards value. In general, I think that's where you want to be this year. And at least until you see what happens on this growth and inflation story, I think this has plenty of room to run.
Yeah, it doesn't mean own no growth, but it means that
tilt,
yeah.
Right? And so we're not all or nothing, right? It's tilt. So I would rather marginal dollars be put to work at the value side of the equation. And that's what I've been personally doing as well. And if you look at our strategies, that's what we're trying to do here. So we're pretty bullish on the value story. I think it is time to do it. Yes, it's ran a lot. I look at the chart up there. It's ran a lot, but also it was way above average, right? And if you look at the last time we had extreme readings back in '99, look at the outperformance. Now maybe it's a little bit different because growth actually has earnings and stuff like that this time, but there is a huge difference here, and there is plenty of room to run.
Yep. Here is large cap versus small cap, S&P 500 versus Russell. Huge outperformance on the Russell. Kind of given some back in the last week or so. We're down I think 7% off the highs, but it's still a pretty good run.
It's still a good run. This looks a little bit more normalish now. One thing I read this morning was that the S&P equal weighted index, right? So you put 1/500th of your position in each stock, so you don't bias it on market cap. That's outperformed the S&P for 7 months in a row. The longest streak really since you saw that, since the tech crash. So I think what that is that's just catch-up trades. This is saying that look, the stuff that did extremely well in that environment it looks distorted. It looks a fair amount rich. And so why not take advantage of that knowledge and rotate around? This doesn't say sell everything. It says move in that direction and put that marginal money to work. If you have cash flow, just like we're talking on the bond side, you got cash flows and stuff, rotate a little bit around.
Yeah, I mean, it's not surprising as you talk about the equal weighted with the market cap weight, that active managers are having their best start to a year in a decade.
All you have to do is fade the market cap, right? Yeah, so it's the anti-ETF trade, right? And so this is the thing about the ETF structure. It works, buy and hold works. It works great in bull markets. But when you get divergences, things can change. And when it comes to valuation, that which is the highest weight in the index typically has done well. Unless those earnings caught up with it and performed in line with that stock performance, that means valuation's gotten more expensive. And so this is the thesis that other shops have written about for years about why you want to fade against a market cap weighted index. And so I've always told people that a market cap weighted index, or the ETF, like this S&P or whatever you want to call it, what that is, that's a quintessential bull market trade. Right? It's the things that do well. It's quintessential momentum, and that's what we've seen. And it was a momentum market, which is why that's worked. So I'll be curious to watch the fund flows as well. We study a lot on the fund flows, on what that looks like in the equity market if people actually start to rotate. Yeah. And you've seen it. You've seen it in the performance. But will they persistently do it and continue to do so? That's to be seen.
Yeah, I mean, I personally invest in a lot of active equity managers. I'm an active bond manager, so I want to believe that.
I believe it. I believe in it too. And look, at the end of the day, I like systematic stuff. I'm a quant, so I'd use a lot of that. But I do buy some of those, and I know we share some of those investments too. We share ideas on who are good managers. But yeah, there's skill out there, and I think it's going to be more differentiated as we change the dynamics of the economy, because you can't use the same playbook you used from 17, 18, 19. You've got to change your thinking because of the monetary expansion, the amount of fiscal side that's coming into the equation, and the potential for inflation. So you need to dust off those older playbooks, not the most recent memory. And I think as you do that, I think that's where active management's going to have its chance.
Yep.
And look, if it doesn't work in this cycle, then maybe there's going to be a lot less active managers, but the good ones will still outperform.
Here, this is the wild one, and we've been saying it looks wild for a couple of years now.
You could have me on tape for about 5 or 6 years going, wow.
This is the U.S. equity prices versus the rest of the world. Every time you've tried to say the top is in, it's gone higher.
Yeah. I hate the phrase that gets thrown around here. It's the U.S. exceptionalism, but sure looks like we are exceptional, doesn't it? A lot of this is we rode the tech wave too. This is a technology-driven market. And the best technology in the world is here, right? In parts of Asia as well. So what you see in this chart is just an example of that. But look, if there tends to be reversals in this, I've called the top in this too many times, and I've been wrong every single time. I'd like to say I hit that last one at 1.8 up there, but no. But look, I still like buying things outside this country. I do think Asia still looks a lot cheaper. I think Europe looks cheaper. Europe has a problem, especially if Europe continues to have the COVID problem they're having right now. I think you have a good buying opportunity there, especially with where the euro's been. I think if you get some devaluation of the dollar, owning international equities is a good place to be, especially if you're long this trade, you've been it. It's a great time to rotate some. And then lastly, obviously emerging markets are attractive in there as well. Now, what are they, about 10% of the market cap of the entire world?
Yeah.
So it doesn't really show up big in this chart. But definitely, we're seeing some of the reflation of the Japanese banks, things like that are happening.
Yeah,
so.
I mean, I just look at this chart. It just says you're supposed to try to buy some stuff outside the U.S. I started buying some more EM and last year. You just got to keep legging in. I mean, it's going to be volatile.
Yeah, and the problem with it is it keeps going up too right now. So it doesn't feel like it's cheap, but when you see these charts, it is, right? And also when you look at valuation, you look at CAPE ratios of Europe, you look at CAPE ratios of Japan, you look at it of also the emerging markets, it's way cheaper. And so I'll play the probabilities, I'll play the long term there that over the next 10 years, those places will likely outperform. Even if it is 5 or 10% on that chart, that's 5 or 10% more that's in our pockets, right?
Yeah, I mean, as a bond investor, because we're looking at nominal yields all the time, it's, you look at a chart and when it's gone up a lot, you're like, oh, it's expensive now. You got to kind of take a step back and say, well, there is growth out there. There are companies that are growing, their earnings are going higher.
Yeah,
so
right.
It should be higher. It's all about kind of on a relative basis, then you actually have to look at the actual valuation metrics as opposed to just price.
Well, in bonds, they tend to always mean revert to par, right?
Yeah.
Or they default. So the problem with stocks, they don't mean revert, right? So yeah, you have a bunch of losers that will go to zero, but you have also a lot of winners too in the markets.
Yeah.
And so that's what you need to play.
Going back to Europe, you mentioned it. We've talked about Europe looks cheap. Europe looks cheap for years and years and years, and always looked cheap and keeps losing.
Yeah, well, some of that
US.
too was the dollar strength too for a little bit there too. But you notice that this chart, we have a different time frame than the previous one too. So it looks like, man, it's been sideways for a long time. That sideways-ish behavior is really 9 months, right?
Yeah.
So again, this is still, Europe is mired in a problem. They're having trouble with the vaccine rollout. But I do think when that starts to open back up, it's a good place to be parking money. So as always, you'll never catch the bottom in it, especially in a relative value trade. You got to start legging in. And so I as well have been buying some more of our international strategy just for that reason. I think that it's a good way to diversify out for some of this other risk. Not selling, just moving some money from bonds into it, right? That's a good trade.
This is the MSCI EM relative to the world. So is EM doing better than and the world is largely more developed countries, as we just talked about.
Yep.
And then, these are more commodity-driven markets outside of Asia, which has more tech. And as industrial metals do well, that's a sign of growth, right?
Yep. Absolutely.
As we've seen copper prices do well. So just another reason that perhaps EM has more upside from where it is.
Yeah, I mean, the divergence here is huge, right? Like if you look at this over the last 7 years, you're noticing that it's really, you haven't seen this level of divergence. And why I also say it's a divergence, notice the directionality on that black line isn't going the same direction as the red areas. So I think a lot of that's because of the COVID related, especially like Chile, Brazil, the LATAM countries have been suffering pretty severely in this last bout of the pickup in the wave. And so you're seeing depression there too. So again, if for an astute investor, I would want to buy at this point, although we were recommending, the Asian economies last year, at this point, if I'm buying EM, I want to focus on LATAM. Mm-hmm. And so our bond portfolios aren't doing that as much because the yields aren't as attractive there. We're still kind of balanced between EM and Asia. Between LATAM and Asia in our EM fixed income portfolios. But I could definitely see that picking up. Once we start to turn the corner, those bonds will make a lot more sense too. So I think it is time to be legging into LATAM as well. And if you listened to us and bought that kind of Asian trade in the fourth quarter, I would do a little rotation on it too.
Yeah, and this shows the different EM markets, and I've mentioned it a lot in my intros on Channel 11. Is the Asia last year was leading the way. It's got Tencent, it's got Alibaba, they've got way more tech in their index, and LATAM, for example, much more heavy in countries that have a lot of like commodity exposure.
That's right. Yeah.
And so that's also why they've lagged. And so if you want to play that rotation, that's kind of one way to do it.
Yep.
And then here's another view of EM, growth versus value. In that growth is going to be more of those Asian tech companies.
It's amazing that they've moved in lockstep almost until the pandemic, right?
That's
so
right.
Unlike in the US, the value growth has been very similar. I mean, look at those lines. I mean, they're right on top of each other until, okay, you could argue maybe in the second half of 19, there's a little divergence there, but man, it really gapped out. And so, again, people don't really think a lot of times that EM is like value versus growth. But this shows you just globally, it has been a growth versus value trade, at least for the last year or so. It's been exacerbated in the US for a decade. But this just shows you that these relationships still kind of hold outside the US. So it's thematically the same.
Yep. We talked about commodities earlier.
What an ugly chart, right? Like, look at that, like just how depressed that is off the 2006 level up there when oil hit $150. But this seems like it's been a real move, right? And if you look up the lows, I mean, commodities only up 50% or so off the low on the basket. But I do think that this still has room to run. The supply side is going to be constrained if demand is really picking up, and we know commodities move quickly. So that's the nice thing about the commodity market is that if we do see that, prices respond very quickly. They go both directions. Like we saw with oil dropping 6-7% in a day and bouncing back 4 or 5, just based on that kind of demand destruction concept. But when I look at this chart, it says, okay, we got to really break above this 85 number here on the BCOM. If we do, it tells me that we're going north of 100. That's a big move. That's a 15-20% move that someone can capture. And I think what you need here is you need the dollar to not continue to strengthen. And it hasn't really strengthened much. It's been a little bit of a bounce, but if we start to see the dollar devalue in any meaningful manner, the commodity market will definitely benefit, plus just the growth story. So I continue to recommend commodities. I like the commodity space, and again, I have a decent position in commodities today.
I started adding last year as well, just kind of like trying to get some of that reflation.
It's the reflation
also,
idea.
we're bond managers, so we could use some inflation hedge.
I can use a lot. I could use that too to offset my muni position, right?
Yeah.
That I own too much of. But yeah, no, absolutely. And look, I mean, going into the year too, I mean, I've been a buyer of risk. Like I've been rotating out because I'm like, these munis don't make sense at these levels, right? And I don't like the duration. And I also live in California, where the budgets aren't great, but the tax benefits are good. But you can make good money in these other areas. And so,
do you have any recommendations on? Of course, you can buy your fund that you manage, but just if you want to play it with ETFs, or sometimes there's some ways to get exposure that aren't that great. Like there's some commodity funds that instead of owning T-bills underneath the futures, they own like tips, and if rates go higher, that crushes you.
Well, that's why when we set up our strategy, we just said, look, we do a lot of overlays and stuff with other products where we run actively managed bond portfolios. When we did our commodity strategy, we said, look, you want commodities, just they're pure, be that way, collateralize them with T-bills. So that's why we did that. The other thing is that a lot of people don't understand is that term structures play into there, and like how the ETFs or the manager invests has a huge impact on the return. So you'll see oil prices move 100%, and then something like the USO ETF, which trades front months, only be up 30, right? And investors are like, well, this doesn't work. No, it did exactly what it's supposed to do. It rolled the position. There's a cost to doing so. So what I would recommend to people who don't want to own our stuff and want to go do it elsewhere, what you look at is things that buy out the curve. They buy 3 months out, 6 months out, or that buys each of the 12 first contract. So now you have a more robust exposure to the oil market. You're not getting whipsawed by the supply and demand shocks on the front end. So there's things like that. I just happen to know that one.
What about like buying the producers?
Yeah, well, the producers, see, I'm conflicted because the gold miners, I hate gold miners. I've always hated gold miners. You're never going to change my mind on gold miners. They're the worst ran companies in the world, and they recycle management. So when you're a bad manager of company A, you get hired at company B. It's like whoop-de-doo. Now this person, they're bad at hedging and those things. But on the production side in mining and energy, that can be much more lucrative. And so I'd be cautious of things on the precious metal side of doing it. I'd rather own the precious metals outright, whether that's gold, silver, platinum, palladium. Palladium would be if there's still more demand on the car side, could be very strong as well. But I wouldn't buy the producers there. But copper producers, nickel, they tend to be the miners tend to get a few of those kind of industrial metals together, like a Vale or something like that. But ultimately, if you're going to play the commodity producers, I would do it in mining and energy. I wouldn't do it in the mining for the precious metals.
Yeah. I think this is the last slide related to equities, but I just thought, we talked about the dollar. The dollar is important. It's important because of course, relative performance in certain markets like emerging markets. If the dollar's strong, that's going to be hard hitting for some parts of emerging markets.
It's also important for U.S. stocks. Don't forget that like half the S&P, has production, has earnings outside this country.
Yeah.
So it can go a couple ways. One is like it can be accretive if the dollar declines. It can be a headwind if the dollar rallies. But also think about your own consumption. Do you buy everything made in America?
I'd like to.
You'd like to, but it's difficult, right?
Yeah.
And so import prices, if the dollar devalues, it costs us more money. So that's another reason to want to own some of these, kind of European exposures or emerging markets or Asian exposures, is because you benefit from that idea that if we're going to produce there and consume in this country, you can get that. And if the dollar is if the dollar is a headwind because it's declining, that's actually good for those positions too. So it's amazing when I look at this chart because we look at it on a much more short-term basis. And when you look at this, you just see that the dollar has been in this really kind of narrow range for the last 6 or 7 years, right? It had its big move, at the end of 14, but really it hasn't done much since then. And it feels like it was a lot, right? It feels like a lot. There's a big decline there, and there's the bounce, but we're talking only a couple of percent or so. So
definitely felt better traveling, exchanging money in the 2010s to 14s.
Yeah, I remember one of the first times I ever visited the UK that the pound was like 2.2. And I was like, okay, well, I knew about interest rate parity and FX and all this stuff. And I'm like, you go to the pub and it's still like, £6 for a pint. And I'm like, dude, it's like a $13 beer. I should at least get the New York atmosphere if I'm paying $13 for a beer, right? So I was shocked by that the number was the same, but the value was completely different. And now we have the GBP is probably about like 141, 142, something like that. So, but definitely, currencies, what I also see from this, they go in regimes, right? So you have some sideways behavior, you have a breakout, you have the red line in there, kind of showing the lows. And so I say if we break that low and we do it with conviction, then we're going to 80, right? And that's a huge move from there, right? That's a 15% depreciation in the currency, or it's 13, something like that. But that's a big move, right? And again, if you're owning international stocks or something else, international exposure, that's a tailwind to that portfolio. That's an incremental return. So that's another reason for thinking about diversifying outside the US.
Out of the US, yeah. Well, as we talk about the dollar and the dollar dropping, then it's very opportune time to talk about crypto.
Crypto's the time. Yeah.
And I suggested to you that maybe you should try to take the Sherman Show podcast and sell an NFT.
Yeah. So what I asked my guys about it yesterday. I said I could give, on my team, I told them I give them an interest in it if you can tell me how to do it. So within 2 minutes, when the young analyst sent me something, I was like, okay, you get 10 basis points for sending me a link. Okay, who wants another 10? Show me how to do it, right? So I think that if the gentleman who's riding the skateboard can get $500,000 for his, without Stevie Nicks' song, we got some great theme music that one of
for his little clip of him?
I think he's trying to. I've seen the headline. He's trying to get $500,000. I don't know if it actually sold or not. I know Stevie Nicks wouldn't give him rights to the song, but we have rights to the song that we have on the Sherman Show. So I think this has got to be at least $500,000 to $1 million idea. So if you're interested in buying the NFT of that, we'll figure out how to upload it, get it to you. Contact us at shermanshow@doubleline.com.
Okay, we've been going for a while, so we won't spend too much time on this. But gold and Bitcoin kind of moved together, and
kind of, except for that last one, but
until
they didn't, right?
Until they didn't, and I guess the big question is Bitcoin the new gold? Right? Are people saying, and I think, there's some potential validity to that it used to be you should always own a little bit of gold in your portfolio. Yeah. Now it's probably you should own a little bit of gold, maybe a little bit of Bitcoin.
It's a what if, right? It's a hedge to things. The volatility scares me. I work around a bunch of bond people. So seeing something with 120, 150 vol kind of scares me. I understand the idea behind it. I understand why people want to do it. I just don't know how to value it, right? And so I think that for those of you that are concerned about it, just buy one or buy a fraction. Just be in the game. At least you feel like you did something.
Yeah.
And look, it's got bubble-ish tendencies. Is it worth $1 million? Is it worth $100? I don't know.
It could be worth zero.
It could be worth zero, and it could be confiscated. Gold can be confiscated. It was in the past, right? So I don't know how to think about it, but I've talked to some very smart people in the space, and the question I say is how do governments allow it, right? You can say, okay, well, it's they don't have to allow it, it's libertarian, you can do all this. But the way that they can disallow it is they create their own.
Yeah.
And guess what? They're only going to transact
They're already doing it.
Right. And so there was another great paper. I'm plugging all the PMs today, but if you go back, Bill Campbell, our global bond PM, he put a paper about central bank digital currencies together last year. Great piece talking about it. I think that if this continues to run in a meaningful manner, I could see the Fed and them stepping in. Whatever happened to Libra? How come we don't talk about Libra? Remember that? The whole initiative, the banks were in there, Facebook. I guess no one trusts Zuckerberg anymore.
Yeah.
But that being said, what happened to that? That was something that everyone was coalescing around. So maybe now that the pandemic's over and they start to look at this stuff, maybe it changes to some different standard. I don't know. And look, Bitcoin's the bellwether. It's the one that's well known, well quoted, has the best memes of everything out there. There's probably only going to be a couple of winners in this space. Ethereum has its own benefits of being able to branch out on the blockchain. So I think those look like the winners, but so did Netscape, is what everybody likes to say, right? And we know that Google dominated that. So I just don't know. Yeah. But if you have FOMO, there's one way to cure FOMO. Just get a little bit. You don't have to go all in. You don't have to sell your house and buy Bitcoin, right? You can go buy one. Go buy a fraction of one. Just do something. And Sam Lau, who's my co-host on the Sherman Show, he got some payment in PayPal, and PayPal's like, hey, do you want to convert it to Bitcoin? So he did. So he's long like $20 of it. He feels great. He's not looking at his bond portfolio.
He watches Bitcoin more than the stock market.
That's probably right. And he's probably that 20 is probably worth like $30 now, and he's stoked about it, right? But that's an example where just a minute amount can change your psychology, and he feels like he's in the game. Yeah. I'm not criticizing Sam, but I'm giving it as an illustration to people. If you have the FOMO, participate a little bit, but you don't have to go crazy.
Yeah, it's funny as investment people, we get asked about probably everything but bonds. Nobody wants to talk about bonds, right? So you go at Christmas time, I always get some relatives. What do you think about, for a while it was Tesla. I should have told him to buy it, of course. It was way lower in price. And of course nowadays you get the phone calls about people asking about Bitcoin. But I say the exact same thing. I say, be prepared for it to go to zero.
Right. And how much are you willing to lose? And I saw that with the retail mentality of like, well, I bought GameStop. Who cares? If it goes to zero, who cares? That's not a good investment, right? That's not investing. If you like, who cares? It's gambling, right? And look, gambling was taken away from a lot of people for a few months. So I completely agree. But remember, these are narratives, and these narratives permeate. Every year you can go back and say, what was the narrative of the market, right? Bitcoin, it was 2018, if you remember, 2017. Going to there, everybody met for the holidays. Yeah. Everybody bulled up, bought it, and then it collapsed again. Not saying that's going to happen here. It seems to have a different kind of ability around there. But the fact that you can buy a Tesla in Bitcoin today, who cares, right? But I think that some of it, as you want to send us that money on that Sherman Show NFT we're going to create, I think some of the reason you've seen that NFT fad, or not, I won't call it a fad, the NFT phenomenon, is that people have this cryptocurrency. It's appreciated a lot, right? So they're using that to facilitate these transactions.
It's very similar in thematically, right?
Right. And I think you were the one that pointed out to me, because I was like, what are you doing with all this stuff? And you're like, well, people used to play Diablo and trade swords and buy this from people and outfits and stuff. And what's the difference? And I agree. If it's art, you appreciate it, go for it. Yeah. And that's what art's supposed to be. It's supposed to mean something to you. And if it means something, and if you think Beeple's, a collage of all of his things is worth $69 million, so be it. You think it is. Yeah. I don't, but I didn't bid on it, right? Yeah. So maybe someone thinks it's worth 80, and that's how things transact. So, the Bitcoin, we'll see if it has institutional acceptance over time. And look, if this is just the move that it gets started, there's going to be a lot of wealthy people.
All right, we're running towards the top of the hour, and we got to both jump on a call soon. So, let's go some questions from the audience. I've listened to the Sherman Show podcast, which I enjoy. Who's been your most memorable guest so far? Other than me, of course.
Memorable guest. Wow, there's a lot of them. My favorite guest, it was just because he's one of my heroes, was Jim Grant. And I think
he's great, yeah.
Yeah, I think I'm one of the few people that got a lot out of that interview, because it's just that he's just so spot on, and his vocabulary is immense too. I've enjoyed a lot of conversations, people that I didn't even know if I would, like an Anthony Scaramucci, right? just a very brilliant guy, a student of history. And he gets a bad rap because, he was a press secretary, whatever.
For like 3 days.
Yeah. I think he now calls it a scaramucci, and it's like 7 days or 8 days or something. But, and I've had just like intriguing guests that we ramble like I've been doing today, like a Danielle DiMartino Booth, like just great insight. And so, always looking for new guests. And it's nice because a lot of it are like people I read from and, people I admire. And we get to have a conversation with them. So
That's cool.
It's a good platform. So.
Awesome.
And if you have any more guests, let us know.
How did you get started in this business, and what advice would you give to a new analyst?
How did I get started in this business? I went to school and got a degree in financial engineering, thought I was going to change the world and be a stock analyst like everybody else and make a lot of money. Found out that math doesn't lead to the answer because I was a mathematician, and that all models are just models, they're guides, they don't work. They give you estimates. There's a lot of good thinking. So what I would recommend to any analyst is study history. I would say read journal articles. I would say find a mentor. Find someone who loves markets that wants to share that insight with you, and someone who's willing to challenge you. And I've had a couple of those in my career, and it's really helped me. And surround yourself by smart people. Don't be afraid to have people who are much smarter than you and ask them questions. And I think a lot of this is learning experiences. I learned a lot during March of this year. Worst market I've seen, right? And so what I was doing was talking to Greg Whiteley, our government PM. And he was around the 80s. He traded treasuries back then. And he's telling me how it's way worse than it ever had been in liquidity bouts. And so we learned something from that. And so I think that's the important thing. And some of that's the one thing we lack a little bit in this work remote environment is that ability just to have a casual conversation on the desk. But be a sponge, get information. And pull down data sets yourself. Pull it down, look at data, look at relationships, and challenge ideas and just read. All those couple of things, that's all it takes.
Just that.
Just that.
And time. It just takes time.
Yeah.
Are gas prices going up due to Biden's energy policies?
Due to his policy, there's been a lot of criticism about this, that like because of his Keystone pipeline, that's there's gonna be no more drilling jobs. Look, we have a dependency on oil. So I don't think that's the case. The reason energy prices are up is because we're importing a lot more oil. So it takes time to get the things back online. So will his policies drive gasoline up? Not sure. I paid over $4 a gallon this morning when I filled up the car. I haven't done it in a while because I've been driven a lot. So it did feel a lot higher for $60 oil. Shouldn't have a 4 handle at the gasoline.
It's California,
pump.
though. We have like the most expensive gas.
Yeah,
in America.
but if you remember when oil was 150 a barrel, gas hit
I
$5.
don't think we. Yeah, I was going to say
hit $5.
That was the highest.
Right, but it's 60. Right, so you can say there's inflation. Yeah, we put more taxes on it and the likes. But so is it? I don't know. It's debatable. But ESG. People don't want to buy the oil producers and things. So I just think that we're going to continue to have oil for a long period of time. We can go other directions. You can have a Green New Deal, but at the end of the day, the cars still use gasoline.
Yep.
Yeah.
Okay, predict the future. Where will the S&P end the year?
Somewhere between 2,000 and 5,000.
Yeah.
That will help. It'll end up higher. It'll end up higher from today's level.
Yeah,
There's going to be noise around it, but I think earnings look good. Earnings look good. I think the multiple contracts some, but I think we grow. So I think it's a healthy thing, and I think that instead of focusing on the S&P, you want to focus on some thematic ideas we talked about, like a value, tilt that direction. I think owning stocks is not a bad thing at these levels. Mm-hmm. It's just look, I wouldn't want to buy the high flyers and stuff like that. I wouldn't want to put a marginal dollar
not
there.
Everything is at the all-time high.
No, buy the equal weight S&P. Like I think that's a better trade still right now, and I know it's done well. So that's my cop out. It's higher, but I don't know exactly what it looks like.
Okay, last question. I guess you got to put a time frame on this, but will the dollar remain the world's reserve currency? For now, yes, but
for tomorrow, yes. Next week, yes. This year, yes. 10 years, probably. I think there's a lot of correlation between the reserve currency and the military superpower, right? And so we helicopter drop money. You ever been to a place like Cambodia? You go to the ATM. Do you know what you get out of the ATM? Dollars, right? They have their own currency, but it's dollars. So we've done a great job of propagating the dollar. We also enforce it with a lot of weaponry. And so I think as long as you have that, there's a good balance there. Now, will China usurp the US in GDP in the next 10 years? Yes.
Yeah.
I think that's the case, but that doesn't make it the reserve currency. And so I think there's still the American spirit. And I know we're biased, we're Americans, but Go around the world. They're listening to Tupac. My wife went to Africa and they're listening to Tupac. They're like, you heard this song before? And she's like 25 years. My husband loves it, But anyway, so there's something about pop culture. There's our movies. Like there's a lot about America that does it. And I think it's all of those events. But will the dollar get devalued? Likely. Will a lot of fiats get devalued? Likely. And I don't know what that looks like. But ultimately, I do think that part of U.S. exceptionalism, I think, lasts through at least the majority of our lifetime.
All right. Well, I think we went almost an hour and a half, so thanks for your time.
Yeah.
And it's good to see you.
Yeah, you as well. Maybe that's why I'm so loquacious today.
Yeah, very good.
We miss each other. Yeah.
That's right.
Yeah.
And I hope everyone out there that's watching is safe and healthy, and your families are safe and healthy. And thanks for your support of DoubleLine.
Appreciate it.